Hello everyone and welcome to the Outspoken Market. Leandro Guerra speaking. And in today's lesson, I want to tell you the truth about inflation protection, about inflation hedging. When we try to find investments or any type of assets that would work as a hedge to inflation, the first thing or the first asset that comes to our mind is gold. Yes, amazingly, it is the gold, which it's something that it's not wrong, because if we pick up 1994 up to now, August 2025, so about 31 years, we are going to see a fantastic 860% return for the gold. One may look at it and say, yeah, I'm pretty sure it has beaten inflation during this time period, because we didn't have inflation as high as that, which precisely it's true. So if we pick up the CPI from the Bureau of Labor Statistics from the US, for the same time range, we would have 123% of inflation. For some years here, between the end of 1996 up to 2005, gold prices, the returns, they underperformed the inflation, so they were not a hedge against inflation. But then after that, since we are always speaking about long term for investments, well, we have nothing to say, so it definitely is skyrocketed. Now, when we discount gold prices for the inflation, we are going to see that well, it's not so majestic as we may think, but yet pretty good. Instead of having a nominal return of 800 and something percent, now we have 324. Yes, you not only preserved your purchasing power if you have bought gold, but actually you would have more purchasing power than if you have done nothing or just have followed the CPI. I would like to make a parenthesis, because the CPI, it's a basket of goods that are measured and it changes over time. And it's not the same for everybody. It's not fair to say that every person feels the inflation in the same way, because not necessarily you purchase the same amount of goods in the same proportions that the CPI measures. So you likely feel a much higher inflation, and not only feel, you feel it in your pockets, that the inflation is way higher than that. And well, this is a very fair comment to say. If we want to be really fair, eventually this 300% of returns of gold discounted by inflation maybe would have guaranteed you some parity. And then you have this inflationary, and then you're gonna read the news about finance, about investments, and they say gold is the safe haven for it. It's the natural hedge against inflation, and stocks are not. And they are wrong. If we pick up for the same time frame the S&P 500, we are going to see more than 1,300% of accumulated return. It not just outperformed gold by a very high margin, but even inflation, because if we do the same calculation and then we put it here, the S&P 500 discounted by inflation, you would have 200% more returns than if we had purchased gold. This is the tricky part, because lie with statistics, lie with data, torture the data to show or to favor your narrative, it's quite easy. And here a clever person would say, Leandro, how do I know that your chart, this time period that you chose, it's not just to favor your narrative? I'm going to prove you that is not in a few minutes. However, I want to show you the other way around, that people, they are going to lie with the statistics intentionally or just by mistake if you don't pay attention enough. Now, if we go forward to 2008, when we had the crisis, the subprime crisis. So starting 2008, you will see that the numbers eventually, they are not necessarily majestic as we have seen since 1994. Actually, S&P 500 yet outperformed gold, but by a very small margin. And then when discounted by inflation, even lower. And then inflation is still, it's eating your salary and the return of your work. If you were back in 2011, 2012, few years after the crisis, people here would be saying exactly the common sense that the hedge against inflation, it's the gold. Because look here, it's start counting in January 2008. The green line, it's the gold. The purple line, it's the gold discounted by inflation. And they are far away from the stocks by a large margin again. And during these 6-7 years, people will be saying that you should invest in gold because gold is what's going to protect your purchasing power, would keep you safe from inflation, and blah, 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 blah. But then if you just keep going, moving forward as the time passes by, whoa, it's not difficult for these stocks to really again come back to outperform gold. What is the point here? If we pick up a stock index like the S&P 500, the point is the following. All the companies that are in there, this kind of index, they have a survivorship bias, because if one of the companies that were listed here in the past, if they have bankrupted, they're gone and they are just replaced by something else, right? So that's why for common investors, you don't need to cherry pick the stocks, you just buy the index if you want to have the average of the market, which will be absolutely fine for you to hedge against inflation, for example. But my point is the following. All of the companies that are listed here, assuming that they started to be listed in the index or they were eventually already there, if there is an inflationary scenario, the prices are going to rise, and the companies, of course, they are going to rise their prices as well, not because they are greed. The people from which they buy the raw materials, they also had to raise their prices. So it's a loop. Everybody raises the prices, so this price it's gonna end being paid by the consumers. Looking at that, of course, the profits of the companies, they are gonna rise, so the revenue, not necessarily in real terms, but for sure in nominal terms, and this is reflected in the stock index. And it's quite easy to see here. It's extremely easy. You have more than 140% difference when you discount the S&P 500 by the CPI, right? That was about 40% since the beginning of our point over here, that is March 2012. This is the point. And you can keep going. You're going to have eventually some periods of time on which you will have gold overperforming, underperforming. But if you look for the long term, there is no comparison at all. Of course, if I add a chart over here of a fellow friend, and let's do it, eventually it's going to be a little bit unfair, maybe, right? That it's Bitcoin. But here I will touch in another class. Now, without getting into Bitcoin, there is still that open point. Leandro, I have seen while you were moving the chart, there were periods on which gold has overperformed the stocks and vice versa. Can I assume that it's true, or you, Leandro, is not lying with the statistics, as eventually you said other people may do intentionally or not intentionally? Now, here is the point. We have this amazing book that is called Stocks for the Long Run. by Jeremy J. Siegel. They conducted a long-term study, and I really recommend you to read the entire book. It's one of the best of its kind, if not the best. They are gonna prove you that despite you have some windows on which gold, yes, outperform stocks and it's the perfect hedge against inflation, if you look to the long term, by far, this is not true. And you can see over here. So the annualized returns from stocks since the 1800s, if you have invested a single dollar, you would have more than $2 million. Of course, nobody lives 220 years, but we are speaking about long-term investment. We have life expectancy higher and higher every new generation. You accumulate the return of your work, you invest, you're going to leave that money to your family, to your children, and then your wealth, it's going to be protected if your wealth it's in stocks. Yes, it will be very volatile sometimes. We are in a very long bull market since the recovery of the 2008 crisis. I'm not mentioning 2020 because we have been inflated with printed money. The drawdown that we had in the stocks, they were recovered in less than 6 months for most of the cases. So if we look long term, since 2008, we are in a very, very long bull market. You guys are the sons of the bull market. Maybe you have never seen a bear market and you were very scared with 2020, which it's not necessarily a bear market like we had in 2007, 2008, 2009, as we have seen, or even before. We have no idea, nobody knows when this is gonna happen again. The point is, it's going to happen again. When that happens again, people will be claiming eventually that stocks, they are not good hedge against inflation, and all the narrative will start over. But you, if you protect yourself, you are able to have cash during the next stocks down, and you are able to do some dollar costing average, and you wait 15 years, 20 years, you're going to live a lot. The stocks are going to be the perfect hedge against inflation. And remember, I'm not speaking for you to become Warren Buffett. I'm not talking about you cherry picking the best stocks. I'm speaking about you take some savings, you invest on it, you protect your capital, you do dollar costing average, you must be disciplined, and that it's amazing. Now, what is happening is that the true perfect hedge against inflation, it's Bitcoin. But this, it's to another class. See you next time. Any questions, don't forget to subscribe and to leave your comment over here. Bye bye.